And I'm going to get back to Megan's question. Megan had like a 4-part question. But it was a really relevant question, and here's why. The next one has to do a lot with what we're dealing with right now in the bankruptcy courts, and that's tax returns in the bankruptcy courts. You got to look at it again and say this is a difference between Chapter 7 and Chapter 13, and here's why. Tax return is basically your money that you've paid to the government or money you're going to get back from the government in a form of a refund. So if you're going to get a refund, I might have called it a tax return, but if you're going to, it's a refund basically. If you're going to get a refund right now and you file bankruptcy today, September 9th of 2010, the bankruptcy court estate that is created when you file would be entitled to, let's just say today's September 1st, make it easy, 9/12 of your tax return. So if you were going to get a $1,200 refund, $900 of that would be considered property of your bankruptcy estate. So in a Chapter 7 case, the first thing I would want to do is I would want to look and see if you have any available personal property exemption or wild card exemption where I can slide that $900 in underneath your umbrella of protection. If we could protect that $900, fantastic. We use one of your exemptions, we protect it, and it's pretty much a done deal. The bankruptcy trustee can look at it, and they can verify the fact that you're getting a $1,200 refund, and they can verify the fact that you've applied your exemptions correctly and you have not exceeded your allowable exemption. But can they go after that money? And the answer is no. Now you look at it and say, okay, well, what happens if you can't protect it? It doesn't fit under that. Well, let's say you've used all your personal property exemption and you're entitled to a wild card, you use all that. Now what? Well, that $900 stays property of your bankruptcy estate, which cannot be exempted, it can't be protected, which means that the bankruptcy trustee is going to take that $900, use it with whatever other non-exempt assets that you have, and use that money to pay your creditors. That's in a Chapter 7. In a 13, a little bit different. In a 13, we don't take property from a person to pay their creditors. We kind of do a balancing act. Let's use the exact same scenario. Let's say all the property is exempt except for this $900, and you've received it. The bankruptcy trustee would say to me, Carmen, this is a liquidation case. If we liquidated this debtor's estate, there would be an extra $900 to pay the creditors. So as long as the creditors are receiving at least $900 in the distribution, meaning the lifetime of the repayment plan, the unsecured creditors are getting at least $900, then you've met the liquidation test. And assuming all things being equal, that's what your client's going to have to pay over time. Now, go one step further. Let's say you're in a 3-year repayment plan. You're in a 3-year repayment plan. What happens to that ongoing tax refund? Let's say next year, 2010, you're going to get another $1,200. Well, then you would want to see whether that $1,200 is necessary for your living expenses. So what I like to do is when we're figuring out the client's budget, I like to put in all particular areas of income, which would normally be wages, if somebody's on Social Security, if somebody's on disability, if somebody's on unemployment. Those are all kind of forms of income. Your tax return can be broken down by 12 months and also included in income. So in this case, if I know you're going to get a $1,200 refund because you get the same thing every year, then I would want to put $100 a month in income and account for it already and see where it comes out in your budget. Now, if sometimes it doesn't matter, because sometimes if I put $100 a month of income, it may create an extra $100 a month and less in expenses. In other words, I put $100 a month extra in income, and the expenses stay the same, which shows at the end of the month, instead of having $500 left over, now they have $600 left over. In that case, it doesn't matter. But a lot of people in today's economy, being what it is, need that extra income. So I see people routinely getting $4,000, $5,000 worth of a refund. So what we'll do is we'll incorporate about $400 a month into the budget and show the bankruptcy trustee that these people need this money every month, so that when they get that big refund in February or March, they're going to use that money over the next 12 months to make up for the shortfall in their budget. So let's say, for example, you have $3,000 a month coming into the house and an extra $400. Then at the end of the month, you see that the monthly expenses are $3,200. So you've only got a $200 a month of what's called disposable income, which now you have to pay that to your creditors. There's a lot to deal with when you're talking about IRS debts, IRS tax refunds, and bankruptcy. And I've only scratched the surface, hopefully to give you a better perspective on what exactly it is.